Good morning. This is Barry Knapp with Ironsides Macroeconomics. 6:45 a.m. Mountain Time on Monday morning, May 13th. This is your introductory version of our weekly audio and video summary that we provide to our full clients. That one would be about twice as long with some additional details. And of course, as a full subscriber to our weekly notes, you'll get a 3,000 word complete with 10 or so charts and tables with specific sector and asset allocation recommendations. So by all means, please consider becoming a full paid subscriber. Pardon me. This week's note was titled The Path of Least Resistance. That's a reference to our expectation that all things equal, 10-year treasuries, that is, are likely to go to 5% and create something of a broader risk off in the markets. But of course, all things aren't equal. We get inflation data this week. This is inflation week, and that was a key part of what we wrote about. Now, we had a decent week last week for equities, and fixed income did pretty well, all things considered, given that we had a 3-year, 10-year, and 30-year auction by the end of the week. Buyers of the 10-year auction were losing a little bit of money, but hanging in, and the market absorbed it as a consequence of the policy tweaks made by the Treasury, which started an off-the-run buyback program and is keeping bill issuance higher than the Treasury Borrowing Advisory Committee recommends, which is no more than 20% of issuance. And of course, the Fed made a couple of tweaks too. They hung on to their easing bias, but importantly, they reduced the size of QE, which they tried to dismiss as merely technical. But of course, it's not merely technical. When you own 25% of the outstanding stock of Treasuries, mortgage-backed securities, you do put downward pressure on long-term interest rates. Why they refuse to acknowledge that is beyond us. So that was all well and good, but we also got some pretty downbeat news from the CBO about the budget situation after receiving the April data. April is, of course, a crucial month for this, given that we get tax receipts, which were softer than expected. That was something that we thought was likely to happen, given the concentration of the equity market rally last year. We didn't think there would be nearly as large of capital gains as Treasury was expecting, and that turned out to be the case. But the real issue is on the spending side. If you go through the various largest categories, you see that spending overall is running up about 6% year on year. Social Security up 9%, Medicare up 10%, refundable tax credits, which is largely Obamacare subsidies and eligibility expansion, up 10%. Interest on the debt up 42% and is now larger in absolute terms than the Medicare, larger than Medicaid, and larger than defense spending. This is our fiscal theory of the price level manifestation. These are categories that are almost on autopilot and are creating a increase in aggregate demand that's driving inflation above prior trends. And we continue to believe that the Fed cannot return inflation to its 2% target unless and until we get fiscal discipline or a tightening of fiscal policy would be the best way to think about it. We then had a section on long and variable lags and walked through profitability in the banking system over the last couple of years through the Fed's tightening cycle, how initially you had a hit to return on assets because of provisioning when the Fed started tightening in anticipation of the Fed causing an economic slowdown. When that didn't happen, those reserves were released. But now profitability is below its lowest point other than in the early stages of the pandemic because of the shape of the yield curve. And this is causing tighter bank credit, which is cutting off the supply of credit to real estate development, an issue I'll come back to in our inflation discussion in a minute, but is also making things tighter for small businesses. So that is where financial conditions are tight, and long and variable lags are having an impact on the banking system. So this is inflation week, as I said. There is still one giant deflationary global force or impulse. It applies a little bit less to us than it does to Europe because We are a relatively closed economy, meaning exports and imports make up a smaller portion of the U.S. economy. But nonetheless, Chinese deflation, which was evident in their producer price data over the weekend, remains a persistent downward force on core goods prices. So while they're stabilizing, we don't expect them to start to rise anytime soon. Super core inflation, non-housing services, there are a number of credible sources who think that it could start to ease a little bit, but we do not think it's returning to trend. And then, of course, housing, which is the chart I have up here, if you're looking at the video version of this, that housing inflation is highly unlikely to go back to where it was pre-pandemic because of the damage that primarily the Fed did to the supply of housing and now the supply of credit because of the deep inversion of the yield curve, which itself was a consequence of passive QT and aggressive rate hikes, something we were urging the Fed not to do. So don't forget about retail sales this week. Forget about the GDP Now tracker because we have very little economic data with respect to the second quarter, but we're going to get some more this week. Retail sales will be important. Housing starts will be important, and we'll start to get a better picture of what growth looks like in the second quarter going forward. So for now, stick to the script, have some powder dry for that risk-off scenario we think is likely. If the labor market data starts to roll, then maybe we'll get an opportunity to buy small caps and banks later in the year, but so far, we think the path of least resistance is for higher 10-year treasuries, and that is likely to lead to something of a risk-off. Barry Knapp, Ironsides Macro. Have a good week, everyone. Thank you.